sure most of us have experienced shocks in one form or another, either at the farm level or even in our own households. If we try and look at the country level, what we see is that Kenya has experienced several macroeconomic shocks over the time. And I think what that has done, even more recently, is that the shocks sometimes adversely, push most of, or if not all, most of the key macro variables, either off target or even off, their long-term means. With that, then, the policymakers are usually faced, with the issue of reacting to these imbalances, which essentially tells us that this could be in either growth parameters, so you have your quarterly GDP, or even more closely, if you look at the leading economic indicators. Secondly, if you look at the prices, we've also seen several shocks over the time. That's on the exchange rate, interest rates, and also inflation. So with that imbalance, then policymakers are usually faced with the question or the issue of their action to bring some of those macro variables into balance, which essentially tells us that at the farm level, more specifically at the bank level, then decision makers are usually faced with the challenge of knowing or trying to project the potential actions by these policymakers, and secondly, the potential quantum movements for some of these macro variables. So this uncertainty, it means that either at the board level or even at specific committee level, you have your asset liability management committee. You also have your asset liability, desk, and other committees, are faced with the challenge of trying to project, the movement of some of those variables, and also trying to project the potential or the possible, action by the policymakers. And that essentially tells us that then the decision as to the resource allocations at the balance sheet level, as to whether, to lend to the private sector or even to invest in government securities, and that lead to, to hold cash, becomes quite a challenge. So with that, then this paper tries to look at, in the study period, given this uncertainty, how have banks, reacted or, actioned their decisions, just by way of looking at the quarterly, published reports in terms of the financials for the banks in this period. This of course means that at the policy level, then what we look at is, for example, at the MPC, that's the monetary policy level, then one sees the need for further guidance in terms of these macro variables from the MPC. So far, we've seen some growth in this, in the sense that in some of the MPC, meetings, they've managed to provide some forward-looking, inflation expectation, and also their growth, their economic growth projection. But of course, more needs to be done, more especially when at a time when the country is facing some shocks to aid, better decision making at the bank level. The other thing we've also seen is on the fiscal side. So far, the government has tried to, through the budgetary policy statement, has tried to give us the path with regard to fiscal consolidation. But one gets the sense that this has not been adhered to, and I think, as a matter of fact, we've seen, several supplementary budgets being rolled over into the fiscal year. And I think case in point is this particular fiscal year, where, we've seen a supplementary budget which came out, quite just immediately after the fiscal year budget. If I would maybe now look at the paper more formally, the topic is macro imbalances. So we are looking at these imbalances that have resulted to, out of various economic shocks, and how that has impacted bank lending in the study period, just given the question of optimal balance sheet allocation. It's a team effort from the research desk at NCBA. So we have Raphael, myself, Anthony, and that's Samantha. I will not dwell much on the intro. And I think what we've seen, especially just from the key numbers, is that historically we're able to pick several imbalances across most of the key variables, right from inflation, the exchange rate, a bit on the debt, matrices, and also with regard to the lending rate. Secondly, I think if you look at it more closely, that's more recently, what appears to us is that there has been, significant volatility in the last couple of quarters, which is actually our study period with regard to the key prices. Of course, the numbers or the metrics around the fiscal policy, that's more specifically on debt and how that is financed. Then, of course, we've also seen that transmit to the lending rates. We are very familiar, most of us, with the issue of macro shocks and also imbalances. That has been studied quite intensively at the global picture. More specifically, I think, since the global financial crisis, 2007, 2008, then later on, the Eurozone crisis, that has, elicited quite significant level of study. We've seen most of these papers being published. And I think broadly what we've seen is that these shocks are not really uniform per se with regard to the transmission channels and also their impact on lending. However, I think if you look at the case for Kenya, this is quite different. There is little or even limited work on the impact of macro imbalances. What we've seen is, studies with regard to bank performance and the impact on that, from various macro variables. However, what doesn't seem to come out clearly is the impact of, or periods of imbalance and how that impacts bank performance and more specifically with regard to lending. And I think if you look at the current period, which is, at the background of very sharp shilling depreciation that we've seen in the last couple of quarters, we've also seen the fiscal, space narrow quite significantly. We've also seen a bit of volatility on the interest rates. That's more specifically on the lending bit of it. And that essentially tells us that this paper is quite topical in the Kenyan context. Moreover, I think looking at the practice side of this paper, we've seen challenges with regard to projection and also forecasting at the bank level. And that means that we've had, to keep on revising our forecast with regard to lending, how much we are allocating into fixed income securities. And essentially, what that means is that for the asset allocation, decision making at the bank, then the issue of macro imbalances impact on bank lending, and also how that affects the quality of assets that we are investing in is quite important. And I think what we've done in this paper is we've stretched it to look at also the future, appetite in terms of risk, that banks are likely to have as they allocate their various, assets into either lending or even fixed income securities. So with that, the study will specifically look at an examination of the macro imbalances themselves and their impact on bank lending. Then we'll also look at the impact of these imbalances that we've had in the study period, how that has affected, the bank risk appetite. Theoretically, I think we are looking at the portfolio balance model, which essentially tells us that here the decision is around the allocation of assets into loans and also fixed income. We've seen several studies, right from McKinnon, Baum, and also Banake, with regard to this, portfolio allocation decision. Then if we look at the empirical literature, it's also quite full of, studies in this area. But most of them at the empirical level do not touch, developing countries or countries closer home. These studies have mainly been in Europe, more specifically in Italy. We've also seen studies in Ukraine, Norway, and also more closer to us in the Zambian banking sector. And I think more broadly, there is concurrence from the literature that we've reviewed that macro uncertainties, that evolve from the macro imbalances do actually, affect bank performance with regard to the lending question. However, we've seen little empirical work on developing countries closer home. And that means that if you look at most of the studies so far, none has focused on the quality of lending and also future lending behavior, which is the risk appetite, which is what we are structuring this paper into. And that means that for us, the study will look at the impact of these imbalances on bank lending and the quality of this lending, and more broadly, the risk-taking behavior that the banks have had in the study period. So with that, I'll request David to take us through the methodology and also the results and conclusion. Thanks.
I'll be very brief on the methodology. I'll not dwell much about the issue of the models and all that. Simply what this paper is trying to do is that you have bank lending on one side. So you want to find out how is the lending by commercial bank being impacted or affected by the macro imbalances. When a macro imbalance happen in the Kenyan context, how do banks respond? So essentially what you're modeling is that the bank today will lend. So the first model is the actual lending in that quarter. And then we go beyond the lending. We want to look at what we may call, for lack of a better name, the lending value chain. So it's not only lending, but you also examine how do these shocks inform the quality of that lending. So the first model is on the bank lending. Then the second model is how the macro imbalances are affecting the quality of this lending. And then the third one is how the macro imbalances are affecting the risk-taking behavior or the risk appetite of the banks. Because first of all, a bank will lend, and then it will be cautious about the quality of its lending. And that quality is what will determine the risk-taking behavior. So the risk-taking behavior is more long-term. That's how we are viewing it. So if you look at the lending, the quality of that lending, and then the risk-taking behavior, we may call that the value chain within the bank lending. So essentially this paper covers the period of Q4 of 2020 to Q1 of 2024. So it's using the most recent quarterly data. The reason we are using Q4 of 2020 is based on the data availability. That's the fastest we could go. And then on the theoretical perspective, here we are looking at the BOM model. This model is just looking at the optimization of lending by a commercial bank in the context of noise in the market. So what it happens is that you know very well that when the bank is lending, it will pick all these signals and the noises which are coming from macro environment and also the micro environment. So, and then from there, we are covering 33 commercial banks on 14 quarters, meaning we have 462 observations, and we are using a bank level data. But then I must also caution that, as you'll see later, we are controlling for other factors so that you don't attribute the effect of lending or risk behavior or the asset quality on the macroeconomic imbalances. So I'll not dwell on this, but this is a dynamic model that we are using. So essentially what we are doing is that we are modeling the lending of the commercial bank as a function of the previous lending, macro imbalances, and then we control for the bank factors. And we are using a GMM which is, I also don't want to dwell on that. The generalized moment methods, I'll not dwell much on that. And we have, for those who are good in econometrics and you have some questions, we can have a discussion over lunch hour, so that we need to be fair to everybody. So what do we see? We have three models here. So the first model is just the gross loans and advances as a function of the previous quarter lending. Then we have inflation deviation, US inflation deviation, physical debt, the core capital, excess liquidity, bank size, and GDP growth. Now, the second model, it has the same variables, only that the dependent variable changes to the asset quality. Okay, that should be asset quality, sorry for that, should be asset quality. And then the third one is risk-taking behavior. So how is this study, how are we measuring the imbalances? Because that could be the most crucial thing. So what we are doing is that on the variables, so you have the first three variables is on the lending, asset quality, and risk-taking behavior. So the lending we are measuring by the loans and advances. Asset quality is the ratio of NPLs, gross NPLs to gross loans and advances. Then the risk-taking behavior, we are using the minus Z-score. The Z-score here accounts for the ROA and the ROE and the deviations in them. So this is how we are measuring the macro imbalances. One, the first macro imbalance that you're using is the fiscal deficit. So we ask ourselves, how does fiscal deficit feed as a macro imbalance on the bank business model in lending? So we know very well that when there's a fiscal deficit, the government will fund it either through domestic borrowing or external borrowing. So in the domestic borrowing, it can either be through the money market, that that is through the money market where you have treasury bill and treasury bonds. It can also be in terms of the capital market where you have the treasury bonds being traded. So the idea here is that, so how do we measure that as an imbalance? As the deficit grows, the government, of course, will borrow more. So we are using the domestic financing of this domestic debt, because the higher the debt, the higher there's a one-to-one positive correlation between the debt and domestic borrowing. And then we look at the growth. How is the domestic borrowing to finance external deficit growing year on year based on the quarterly data? The second one is the forex movement. We all know that in the recent years it has been a thorn in the flesh on how the exchange rate movement the exchange is moving, and the issue of the dollar availability and the issue of the argument of the banks holding dollars amid the scarcity in terms of supply when you have more demand. And then inflation. This paper is different in that what is the imbalance in the inflation? We know CBK target is 5% plus or minus 2.5 basis points. So the lowest you goal is 2.5%, 5% is the mean target, 7.5 is the upper bound limit. So what we are doing is that we are picking the quarterly inflation rate. We less the 7.5, the upper bound. Because when the inflation is above the upper bound of target of 7.5, it goes from 7.5 and above, then that is an imbalance because you have the inflationary pressures being more pronounced. Sorry, we are using 5% in this case. We are using the 5%. So we are presuming if it's beyond the 5%, then the macro pressure, the inflation pressure is more in the economy. You have inflationary pressures. The same case for US inflation. We pick the headline inflation. We net their target, which is 2%. The reason why we are using the US inflation is that we know our monetary policy decision here is hinged on what the Fed, the decision by the Fed, and therefore the same will be replicated here. Another thing we know that when the Fed changes their rate, that has an effect on how we expect our exchange rate to swing, and therefore the MPC will make a decision based on that. So we are more reliant on the pronouncement by the FOMC. And then the other thing that now we control for what you call the core capital, and here we are using the tier 1 capital because you know that tier 1 capital is what is required for high risk lending. Then from there we control for the bank size. Then excess liquidity, we measure it from the liquidity ratio less the 20%, which is statutory requirement by CBK. And then we have economic growth. So what do we see? I'll be explaining this and then I'll move to the conclusion and policy recommendation. So the first model is the loan, the lending. So when you look at the FX, maybe a simple for those who are not econometricians or economists in modeling. When you see a coefficient or a figure which has 3 stars, it means it's significant at 1%. That factor is very significant in influencing the dependent variable. 2%, 5%, you will see 2 stars. 10%, 1 star. If it does not have any star, it is not significant at all. So what it tells is that when it comes to the bank lending model, whenever the shilling is very volatile or is depreciating or appreciating, either way, that is very significant in influencing bank lending on quarterly basis at 5%. When you look at the same model, I'm on the first column, inflation deviation, both KE is the Kenyan inflation deviation from the 5%, and then US inflation, they both also have a positive effect on lending. And what tells you is that when you have high inflationary pressures, there is more lending. And what this will imply is very simple, as I'll be explaining later, is that when there are high inflationary pressures, what will happen is that the borrowers will factor to that. If there are firms which are borrowing, and you went in to borrow X amount of money and the inflation has gone up, then you need to factor that you'll borrow more, okay, from the demand side perspective. Then fiscal deficit, it shows that when the fiscal deficit is growing, that is being replicated in increased domestic borrowing to finance that, and that has a negative effect on lending. Mark you, I might say that the lending we are looking at here is the private sector lending. That is the lending net to the private sector net, the government lending is not in here. And these signals, the negative sign here, it is signaling the crowding out effect. That when the fiscal deficit is growing so much, you expect the government to be borrowing to finance that, and if that borrowing is heightened domestically, then banks will move to financing the deficit and less goes to the private sector. And then the core capital has a negative effect, excess liquidity has a negative effect. So what it means is that the excess liquidity having the negative effect, remember we are looking at the period during COVID, Q4 of 2020 to Q1 of 2024. So what it is telling us here, we expect the reverse to be happening, because when the bank is more liquid, and excess liquidity, you expect it to lend more. But here we are getting the opposite. So are the results valid? And to us, they are valid in 2 instances. The way we are computing liquidity here, it is taking into account of what we call the liquidity in the government securities which have maturity period of, which have a tenor of 1 year. And therefore, what these results are saying that during this period, banks were more pro-liquid as opposed to taking the risks during the COVID time and in post-COVID recovery, because the recovery has been there, but it has been quite fragile, as we know from the perspective of the general macroeconomic. So the excess liquidity has a negative effect to lending, which means the banks were pro. In this case, they were holding more. They were holding more of the short tenor government securities, and also in terms of the cash, the holdings in the cash holdings. But when you look at the bank size, of course, the normal you expect, the larger the bank, the more the lending, and of course, economic growth, which is the GDP growth, then we see it as a positive effect. Then we move to the asset quality model. And what we see is that as the shilling depreciates, because you mean it's going up, the rate is going, that is the KS dollar. KS dollar is going up, which means the shilling is depreciating, then it has a positive effect on the non-performing loans to total loans, which has the asset quality is improving. And it's very simple, because this could be alluded from the conversion factor perspective. It could also be informed in terms of when the shilling is depreciating, if the demand for the loan is for the exporters, then it means you are earning more, and therefore the ability to pay the loan is higher. Therefore, you can see that. But there is also the statistical element of the figure. The inflation, it has a negative effect, which means when there's a high inflationary pressures, then what is happening is that the quality of the assets come down, which is expectation of the economic a priori. And then from there, you can see physical deficit. The more financing domestically happens because of the increase the government deficit, then you can see the asset quality improving. And this could be alluded in 2 things from what you saw in this period. One is that perhaps if this domestic borrowing to finance the deficit is going to pay the pending bills, then you expect that to have an effect in terms of the loan repayments. And secondly, the other thing is that we know the government was borrowing during COVID time more to to finance what you may call the stimulus packages. For example, financing things like in the oil, there was the issue of the bit that the government was financing for diesel and petrol and a little bit of kerosene. So we would see that those subsidies, what they would imply is that when you have that subsidy being funded by the government, it has an increase in disposable income, whether from the farm perspective, of the household perspective, and perhaps that could have a signal of ability to repay the loans. So the core capital, excess liquidity, they also have a negative effect, and then bank size has a positive effect and growth. And then the last one is the risk-taking behavior. So we are seeing that as the shilling depreciate, then the banks take more risk. And then the other one is that when there's more inflationary pressures, then the risk comes down, because it means in the long run, the inflationary pressures are factored in by all the engines in the economy, and the bank will slow down. And this will happen because, of course, you have, number one, you have, when there's more inflationary pressures, you have tight monetary policy, and therefore the cost of lending goes up. And then you look at the cost of that lending vis-a-vis the risk in the private sector and lending to the government. So you would channel more funding to the government or lending to the government and lend less. This could actually explain the negative effect. And then you have the core capital. Again, it has a positive effect on the risk-taking behavior. Excess liquidity, it has a positive effect. And then you have bank size and GDP growth. So I'll not dwell on this. This is exactly what I've just explained. And then lastly is that, what do we allude from this? It is very clear that the macro uncertainties are found to have a significant effect on the bank lending, although with mixed outcomes. If you're looking at from the lending model, the NPLs model, and the risk-taking behavior model. And what we are finding is that whenever you have a shilling, the shilling depreciating against the USD, that it increases bank lending, of course, for the dollar-denominated loans. It improves asset quality, and then the other one, it increases the risk-taking behavior. But inflationary pressures, they increase the bank lending, but they worsen the asset quality, and they also lead to risk aversion, meaning that with the inflation, the bank takes less risk. The bank becomes risk averse. The fiscal deficit, it reduces bank lending to the private sector, single-link rounding out effect. It improves the asset quality if this lending is going, for example, to finance subsidies, as you've talked for this period that we are looking around, and also if it's going to payment of the pending bills to the private sector entrepreneurs. And then, but it increases also the risk appetite. The risk appetite here is that we must say that we have already found that when there's more higher deficit, then the banks lend more to the government. The question is, this risk appetite we are mentioning here, it is the lending that goes to the government per se. Because what happens is that if you look at how we are computing the Z-score, the Z-score is cumulative of, it is ROA and ROE and the deviation, which means that takes into consideration the profitability that is coming from placement in government securities, loans and advances, and also placement in other banks. So which means they take into account other lending outside the lending to the private sector. And that would imply that the question has been, does lending to the government, does it make the banks immune to risk? And the answer is no, because there's a sovereign risk that comes to the lending to the government, whether it is the 91 Treasury bill, which are considered to be zero default risk. Because the moment the CBK or the moment the government does a debt rollover, or for example, an 91 Treasury bill rollover, actually that is a default. That's a default. It's only that when you roll over a debt, it's actually a default, if you look at it from that perspective. So there's a risk. The sovereign risk is very eminent. So the fact that you are holding securities in the government, you are holding government securities, that does not make you as a bank being immune to the risk. So that is the factor that we are coming in there. But the aspect of the bank level factors indicate in the study period that the mean of low expenditure borrowing in, the core capital limits were not overstretched, that the banks ought to be more liquid. That is the issue of excess liquidity. The first statement, what it means is that actually the effect of the core capital during this period, you find it that though it is having a negative or positive effect, it is not much significant, and that tells you that the high risk lending was more muted during this period, because core capital would be key in funding what you may call CAPEX. Now, if you look at during the COVID and post-COVID period, CAPEX borrowing by the corporates actually went down because nobody knew about the future, and therefore there was a lot of scaling down. And that is what we mean by that point, that there was no overstretching of the core capital limits. So in short, as we close, what are we giving as policy implication? So number one, there's need of what we call the policymakers to be forward guiding on their possible action path, especially the MPC communication. And in this case, it's because of the inflationary pressures, the effect we have seen on the inflationary pressures and effects on the bank lending, the quality of the bank lending, and the issue of risk-taking behavior. Of course, also there's an element of a call for the need for a fiscal discipline, because you have seen fiscal deficit as it grows, what it's bringing on the government, or on the lending, the bank lending, in terms of the lending to the private sector, the quality of this lending, and also the risk-taking behavior. And then the other thing is the issue of the adherence to the fiscal path, which is linked to the first one. And then the other one is the need for the commercial bank, and that is what, if I listen clearly, Professor Victor Mulinda was talking about in the morning, the business model of the commercial bank. It is good to take into account what is happening from the macro shocks, so that you are able, as you are revising your model, you are able to make these projections, because remember these imbalances, and how we are saying is that the imbalance is anything if it is above the threshold which is set as in the policy. So if it's inflation, the moment you're talking of inflations which are, the averages are above the 5%, you should be able to factor that when you're making your decision to lend. If it is the government policy statement, when they mention about revising their budget, the deficits which are likely to come in, the supplementary budget, all those things the bank should be able to put into consideration in their modeling. And I think the last one, which was an oversight here, could be the need for what you call the macroeconomic prudence framework within the relevant authorities, and in this case could be the central bank. So I think with that, we welcome question, and I wish to acknowledge that I think much of the question will be handled by our chief economist, who is Raphael Aguk, who also happened to be an author here. So I think much of the question coming from the banking floor will be handled by Raphael, but I think from there I can welcome Tiriongo.
I think for me, it's interesting. I'll say that Raphael, who is one of the authors, and I've taken time to commend the team, Raphael, David, and the rest for the paper. I really enjoyed reading the paper. The only thing is that in the afternoon, Raphael will have an opportunity to discuss my paper. I don't know whether to take that as a setup so that I can moderate myself, but I'll start from a very kind note by saying that I think it's a good paper. If you listen to presentation by David, you'll agree with me that it's a good paper, in the sense that it picks on a very topical issue of macro imbalances and how it relates to the bank lending, because bank lending is really the core activity insofar as the intermediation process is concerned. In that regard, it's a very, very critical thing. And I think, to me, I'll have a very slight idea of what imbalances are. I'll not look at imbalances from the context of inflation being above target or exchange rate in a certain way. Instead, I'll look at it from the context of, if you have a very wide fiscal deficit that is perhaps considered unsustainable, or if you have a widening current account deficit that is also considered unsustainable, then those are the imbalances that reveal themselves in either the exchange rate, inflation, the way the interest rate regime operates. In some markets, they even talk about the way the labor market operates. And I think the labor market, which doesn't get a lot of attention in our conversation, is very important, especially if you're a bank and you're actually doing lending to households. So I think those prices, inflation, exchange rates, interest rates, and wages are really the manifestations, or it's how the imbalances are revealed. So in that regard, I think the paper is really spot on. Second is really what I call the vicious cycle that arises from those imbalances to the real economy, in the sense that if you have those imbalances, and those imbalances affect economic performance, then the economic performance will actually lead into the financial sector being affected. And if the financial sector is affected fundamentally, then it will mean that you'll see that feeding into the overall growth. So there's an element of vicious cycle there that I think is mutely implied in the paper, which makes it even more important. The third is really the aspect of this paper anchoring itself on what can call the broader risk management framework of banks, and how those risk management framework of banks inform what can call the risk appetite. And I'll give a few thoughts on what I think it will be a good measure of risk appetite beyond the Z-score that the papers used. It's an alternative suggestion I'm going to make. I'm not going to say that it's necessarily the best, but I think it will give perhaps a different feel to the findings of the paper. So let me start from the end by highlighting what I consider to be the broader findings of the paper. The first one is what you can consider to be fairly obvious, that if you have macroeconomic imbalances, then those imbalances will actually lend themselves in how it affects the lending, and how it affects the quality of the portfolio, and how it affects the risk-taking behavior. Many people casually talk about risk-taking behavior by simply looking at the level of non-performing loans and see that if they are going up, then you expect the risk appetite of banks to come down. But I think the paper stretched it further, which is a good thing, to look at a more formal way of looking at the risk appetite and therefore risk-taking behavior. So that's what I can call the obvious implication of the paper. What's more interesting are the deeper insights out of the paper, and this is what David concluded with. And the first one is that currency depreciation actually having a positive impact on the portfolio quality, especially if you look at it from the context of the exportables. And I think to me, this has made one cardinal assumption, which I wish the paper could have been explicit on, in the sense that if your currency is depreciating, the assumption is that your exportables are becoming competitive in the international market. That appears to be fairly obvious. But I think many of the people in the room will appreciate that the attributes of competitiveness are way much more than currency. Because if you're grappling between an economy where the cost of production is on the increase, then there's a possibility that currency depreciation alone may not necessarily lead into you having good export earnings. That's just to flag an issue that I'll revisit within the 9 minutes. The second is really around inflation and how inflation fits into the whole portfolio of deteriorating quality of bank assets. And I think this can be seen from the simple context of if inflation erodes the incomes of households, or if you see inflation as a tax, therefore it impacts negatively both businesses and households, and therefore likely to feed into the deterioration of the quality. So on the one hand, the exchange rate is leading into improvement of quality. On the other hand, inflation is leading into the deterioration of quality. I'll not look at these in isolation. What I'll instead do is to look at what's the interaction between inflation and exchange rate. And that will probably lead you to thinking that there's a contradiction in the way these findings are brought out. And the final one is really around the mixed effect of the fiscal regime. Essentially meaning that if you have an expansionary fiscal program, the obvious consequence will be crowding out effect, and that one has come out and empirically established in the paper. But I think there's a way in which you can look at the fiscal posture as investing towards supporting enterprise, especially if you're looking at an expansionary fiscal regime that is going to support infrastructure, essentially not looking at it in the short run, but in a much more forward-looking manner. So the mixed effect of the fiscal regime has not quite come out strongly in the paper, and that's why I think I am going to spend a bit more time looking at how these interesting findings play out. Now, there's one thing I've known in the few years that I've done research, or I've been a researcher, and is that when you establish the findings of our study are very interesting, you probably need to start asking yourself a few questions. And the first one I've already implied to it, in the sense that how elastic are our exports to foreign exchange movements. And I think there are a few studies that you can establish that effect. And if you find that no, our exports are not as elastic to currency movements, then I think you start now asking whether indeed the argument that a depreciating currency will necessarily lead into a good quality portfolio is an issue that you may need to revisit. The other thing is really to bring out the fact, and this is what I started with in the paper, of how you actually defining these imbalances themselves. Because the way the exchange rate has been fed into the argument, while there's almost no discussion on the external imbalances, especially on the current account, is something that you actually may need to look at more carefully. Because the assuming, for argument's sake, that currency depreciation leads into you exporting more, that can actually lead into the closure of the current account. So essentially, the depreciation will not be in perpetuity. At some point, the currency will either stabilize or even start appreciating. So in that regard, I think you probably have to have a very nuanced view of this particular finding. The second is around the aspect of the interaction between the exchange rate and inflation, and how the two opposing findings are something that are interesting to look at. If you believe that there is a strong pass-through effect from exchange rate to inflation, then it brings a contradiction as to why you should expect the exchange rate to be positive on the portfolio and inflation to be negative. So that means, therefore, that you may need to revisit at least the arguments that you make around these two variables to the extent that they reveal imbalances, and see how the findings now will sit in a manner that is coherent. The third is around the aspect of how the US monetary policy plays out. And it's true that the US Fed, to the extent that is underpinned by the issuance of a reserve currency, is very important, and many central banks actually look at what the Fed has done and then probably try to align. But we also know that matters monetary policy deploy what is simply known local instruments for local objectives. If the Fed is moving in a certain direction, it doesn't necessarily mean that you move in that direction if your local circumstances don't necessarily lead into you moving that. As a matter of fact, if you look at the latest monetary policy decision, we were ahead of the curve. We moved before the Fed did. So that simply means, therefore, that to argue that will necessarily lead into us responding in a certain way, or kind of forward guidance, may need to be approached in a cautious way. But more substantively, and this is how it comes in the paper, is that if the Fed moves, and that triggers the movement of the local currency, the local central bank in increasing the monetary policy rate, for instance, then that will filter through to the cost of credit. Now, that comes with two accompanying arguments. The first one is that you don't have to assume that banks necessarily are not desiring a tighter monetary policy. As a matter of fact, there's a big argument that can be made that the response of banks to monetary policy is asymmetric, in the sense that when it's tightening, they tend to transmit fully because they stand to benefit out of a tighter monetary policy. But when it's accommodative, the transmission may actually be partial. And there's literature to that effect I can refer you to. But the point here is that when you're seeing the rates going up, it doesn't mean that the banks will desire those rates to go up perpetually. There's a threshold beyond which, if the banks continue adjusting the prices depending on how monetary policy is moving, it will start impairing the ability of the very customers that they are seeking to support to be able to meet their obligations. So if it's a way in which the paper can embed some threshold analysis, especially how some of these things trigger the ability of the banks to, their customers of banks to be able to meet the obligation, I think it will very much support the paper. And then, of course, the interaction between the fiscal side and the monetary policy side, being given what can call an intertemporal approach as opposed to just looking at it from a point in time, I think will be useful for the paper. I think I'll give some ideas in 5 areas that I see the paper probably going to spend time tightening. I alluded to a vicious cycle, which runs from imbalances to growth to affecting the financial sector, and therefore back to growth. There's a different way in which you can look at a vicious cycle, especially if you look at it from the context of what happened during the global financial crisis, and I'm happy that the paper spent quite a bit of time looking at the global financial crisis. The global financial crisis was such that the banking industry, or the financial sector in general, was the epicenter of the shock. So if the banking sector is the epicenter of the shock, and that shock filters into growth, and then it became a sovereign problem, and then it filters back to the financial sector, we saw how prolonged that was insofar as unraveling it. What we have, especially around the COVID period, is a situation where the shock reveals itself more from the growth standpoint. So the epicenter of the shock that characterizes itself as the imbalance is something that I think you may need to look at and distinguish between a shock that arises from the economy performing badly, and a shock that arises from the economy performing badly simply because the banking sector or the financial system is not performing optimally. So that's a distinction that we need to make. The second is you allude in the paper about the structure of the economy being very critical. And you make an argument, which I buy, that if the economy is less diversified, then I think that has an implication in which the imbalances manifest themselves in the effect on the banking industry. So that simply therefore means that you may have to reveal that structure in your modeling, the structure of the economy. But beyond the structure of the economy, you may have to start thinking critically on how you embed even the structure of the banking industry. Because all these interesting findings you make around liquidity vis-a-vis lending and the trade-offs that are arising thereof are not universal across the banking industry. It may well depend on the size of the bank, because the bigger the banks, the more they can get away with some of those trade-offs. But if you're a smaller bank, those trade-offs actually manifest themselves even more in terms of preferring more liquidity than profitability, than more lending. And this speaks to one of the papers that actually Molinde referred to in the morning around the interbank behavior, and how the kind of interbank market that we have actually lends itself into not assuming that the banks are homogeneous. I know you don't make that assumption explicitly, but to the extent that you're alluding to structure, you may need to think about structure both from an economic standpoint and also from the way the financial sector and the banking industry is structured. The third is around the assumption you make around the issue of the risk appetite and risk-taking behavior of banks. And I think here you may need to inject the argument of information and information asymmetry, and this came up in the morning. And I'm glad that you already have that in the literature, because when you make reference to the paper by Benanke and others, actually it speaks to the whole aspect of information and information asymmetry. And underlying that are the two concepts of moral hazard and adverse selection. And what I observe here is that when you talk about adverse selection, when you have imbalances, which is really at the core of this paper, there's a likelihood that risk borrowers have an incentive to seek more borrowing. So where risk borrowers demand more, and on the moral side, you have potential of insufficient incentive for lenders to take care. So the issue of moral hazard and adverse selection, to the extent you make reference to Benanke's paper, I think you may need to consider it in the paper. And of course, most importantly, and this came out, I wish it could have come out strongly, the issue of screening of your portfolio, and therefore relationship management, and how that can be able to support the quality of the portfolio, even on the back of imbalances, is something that I think you may need to amplify. I know you've alluded to it, but I think you may start looking at relationship management and how that is going to be important. I say that because there is an assumption that, and this is an assumption that flows through the paper, that imbalances and lending are necessarily cyclical, in the sense that if you have more imbalances, then you necessarily have less lending. I think you may need to take into account the fact that sometimes the financial cycles actually move faster than economic cycles. If, for instance, you have an economy that is going through a cycle, you don't expect that the financial sector, especially the bank industry, through its lending will necessarily follow that cycle. So the synchronization of the cycles between how the market players behave and how the economy behaves is something that I think you may need to take into account. My final one is on methodology, and this is as I had Raymond in the morning, and I listened to you, David. We don't want to make it painful to anybody. I know you settled on a GNM, and I think it's because it fits well with the data. And particularly the fact that you settled for what you can call a panel GMM, I think it's really important. But the question I ask myself is, to the extent that you have a sense of forward-looking orientation in terms of what this paper will inform, are you seeing the GMM having the benefit of giving you that forward-looking attitude? And given what I've said with regard to the structure and the structure of the economy and the bank industry being very critical, perhaps I could entertain looking at a panel structural VAR as a possible alternative if it can fit the data. That can give you the opportunity of seeing which one fits the data even better, and perhaps address some of the contradictions that I've pointed out in the paper. And the final one is really around the Z-score and how it fits into the risk appetite. There I'll just say two things. I know the Z-score is very popular when you're trying to talk about stability of the financial system. I don't know how appropriate it is in measuring the risk appetite. What I've seen in terms of risk appetite is to look at a comprehensive composite index of what it entails in terms of setting the risk parameters for a bank. And that will include looking at, at what level is the risk appetite set. Because risk appetite is not a consequence of the parameters of a financial nature. It probably, to what extent does the board want the bank to be aggressive in taking risks, especially when there are shocks? How does that fit into emerging risks such as environmental and sustainability kind of risks? To what extent do you have a framework of risk management that can allow you mitigate any risk that you have? And then, of course, that will allow you to come up with a robust measure of risk appetite, as opposed to assuming that risk appetite is seen or inferred from the concept from a computation such as the Z-score. Otherwise, I could have easily said that the paper is very clear and good, but I thought that I'll add value by bringing in those additional comments, and I thank the authors for a commendable job.